A stock being down 30% does not mean it is cheap. That sentence sounds simple, but it is one of the most expensive lessons beginners learn in the market. They see a stock that used to trade at $100. Now it trades at $70. Their brain immediately says bargain. It feels like walking into a store and seeing a 30% off sticker. Same product, lower price, easy decision. But stocks are not shirts on a clearance rack. A stock is a claim on a future business outcome. And if that future business outcome got worse, the lower price may not be a discount at all. It may simply be the market adjusting closer to reality. This is where margin of safety enters the picture. Most beginners think margin of safety means buying something after it has fallen. That is wrong. Margin of safety is not a discount from the old price. Margin of safety is the gap between the price you pay and a conservative estimate of what the business is worth. That distinction matters because the old price might have been insane. If a restaurant was valued at $1 billion last month, and today someone offers it to you for $700 million, you are not automatically getting a bargain. You are only getting a bargain if the restaurant is conservatively worth more than $700 million. If it is realistically worth $300 million, the so-called discount is still overpaying. The beginner uses the old price as the anchor. The investor uses value as the anchor. Think of value as a range, not a precise number. This is another place where beginners get trapped. They want one exact answer. They want to say, this stock is worth $82.47. That kind of precision feels scientific, but it is usually fake confidence. The future is not that clean. Revenue can grow faster or slower. Margins can expand or shrink. Interest rates can change. Competition can arrive. Management can execute well or badly. Because all of those moving parts are uncertain, the value of a business should be treated as a range. Imagine 3 estimates. The optimistic case says the business might be worth $120 per share. The base case says maybe $90. The conservative case says maybe $65. If the stock trades at $100, the optimistic story may still sound exciting, but you have no margin of safety. You are depending on a lot of things going right. If the stock trades at $80, you are below the base case, but still above the conservative case. That might be interesting, but it is not automatically safe. If the stock trades at $50, now you are below the conservative estimate. That gap between 50 and 65 is the margin of safety. It is room for your analysis to be wrong and still not destroy you. Margin of safety exists because your estimate will be wrong, not might be wrong, will be wrong. The only question is how wrong and in which direction. Maybe you overestimated growth. You thought sales would grow 10% a year, but they only grow 5%. Maybe you overestimated margins. You thought the company had pricing power, but customers push back. Maybe you overestimated the multiple investors would pay. You thought the market would keep valuing the company at 25 times earnings, but the market decides 15 times is enough. Maybe something ugly happens that was not in the spreadsheet. A product problem, a lawsuit, a recession, a new competitor, a bad acquisition. If you paid a price that required perfection, every small disappointment hurts you. If you paid a price with a real margin of safety, the investment can survive normal human error. That is the whole point. Margin of safety is not about predicting perfectly. It is about surviving being wrong. Now let's separate what margin of safety is from what it is not. A stock being down 30% is not margin of safety. It only tells you where the price used to be. It does not tell you what the business is worth. A low price-to-earnings ratio is not automatically margin of safety. Sometimes a low PE is cheap. Sometimes it is a warning that earnings are about to fall. If profits are temporarily inflated or the business is declining, the PE can look low right before the stock gets crushed. A famous investor buying the stock is not margin of safety. You do not know their cost basis, their time horizon, their full portfolio, their hedges, or whether they changed their mind after the last filing. Copying someone else's position is not the same as understanding your own downside. And a great story is not margin of safety. A company can have a great product, a huge market, loyal customers, and a brilliant founder, and still be a bad investment if the price already assumes too much. So how should a beginner use this before buying? Start with the value range. Do not ask what is the exact value. Ask what is a reasonable optimistic value, a reasonable base value, and a conservative value. If you cannot build even a rough range, you probably do not understand the investment well enough yet. Second, write down the assumptions. What revenue growth are you assuming? What margin level? What valuation multiple? What balance sheet risk? If the investment only works under heroic assumptions, that is not margin of safety, that is hope wearing a spreadsheet costume. Third, look at the downside first. Before asking how much you can make, ask what breaks the thesis. What if growth slows? What if margins compress? What if the multiple falls? What if the company needs more capital? What if the industry becomes more competitive? A good investment can answer those questions without falling apart. Fourth, compare the current price to the conservative value, not the old price. If the stock fell from 100 to 70, but conservative value is 50, you still do not have a margin of safety. If conservative value is 90, then 70 may be attractive. The drop itself is not the evidence. The value gap is the evidence. Fifth, define the kill switch before you buy. What would prove you wrong? Not what would make the price move against you, but what would prove the business thesis is weakening. If your thesis is based on growing free cash flow, what happens if free cash flow turns down? If your thesis is based on a strong moat, what evidence would show the moat is cracking? If you do not define this in advance, your brain will defend the position after the fact. The practical question is not, is this stock cheap compared with where it was? The practical question is, how much room do I have to be wrong? That question changes behavior. It stops you from chasing falling knives just because they look discounted. It stops you from confusing a lower price with a better investment. It forces you to think like a buyer of a business, not a gambler staring at a chart. Margin of safety is humility converted into process. It admits that valuation is uncertain, forecasts are fragile, and markets can punish overconfidence. It does not guarantee profit. Nothing does. But it reduces the chance that one bad assumption wipes you out. So before you buy the next stock that is down big, slow down. Do not ask, how far has it fallen? Ask, what is it conservatively worth? What assumptions am I making? What can go wrong? And after all that, is there still a gap big enough to protect me? That gap is the margin of safety. Not the discount from the old price. Not the headline valuation. Not the story. The gap between price and conservative value. That is how you stop buying things just because they are down, and start buying only when the odds are actually in your favor.